we have with us Herald Van Der Linde, Head of Asia Equity Strategy at HSBC, joining in the show right now. Herald, good to have you on the show. Thank you so much for taking the time out. Seems the global markets are a little bit nervous in anticipation of what one is going to hear from the Fed, Herald. You know, while it clearly seems that Fed is on course to speed up taper, the question, I guess, is whether it's going to call for swifter rate hike or not. What's your belief?
Yes, you're absolutely right, and thanks for having me on your show, by the way. So we got a few central bank meetings coming up, and of course the decision or the discussion still centers about whether they're going to hike or not, and when are they going to do it. We're looking for 2 rate hikes next year and 2 rate hikes thereafter. But beyond that, and if you look at the yield curve, this is what it's telling you as well. Although we have a period of kind of accelerated tightening coming through, you see actually rates tapering off and going lower again. So yeah, that's still consistent with our view that bond yields will remain lower for longer, for quite some time. Although in the near term, over the next 12, 18 months or so, they might move a little bit higher as interest rates are going to go higher. And you're right, that drives markets. The dollar is a bit stronger, and that sometimes has a bit of an impact on Asian equities in general, not India just on its own. That's a little bit of a negative that we need to deal with.
Sure, I'll come to the India part a little bit later. But in light of what you just, talked about when it comes to the Fed price action or Fed action rather, just wanted to understand whether it's a given that end of the easy money era is pretty much over when it comes to equity returns.
For the moment, it seems that that easy money at least is going to be curtailed to a certain extent. This can have quite some implications. You see, in particular in the US, we've seen very low equity volatility over the course of the last 10 years or so. As we unwind these programs that have caused that, maybe not fully unwind, but to a certain extent unwind, that volatility could actually come back. So that's something that we need to keep a very close eye on. Volatility in Asia has always been higher, and has last year been high, but that's driven by China for all kinds of different reasons. But it might well be that equity volatility is something that gradually becomes a little bit elevated throughout the year. So that's stuff that we'll have to see how that's going to work out next year, and how that impacts markets. But yeah, that's one of the consequences of coming into the QE programs.
So let's see what the FOMC decides. You've, of course, got the 2-day meeting starting today. Market experts of the view that maybe you could see as many as 3 rate hikes in 2022. So interesting times ahead. If that does happen, will we see flight of capital? Indian markets are, of course, far more resilient now. And that's what brings me to the next question with you. With the resilience that the Indian markets have really shown in 2021, outperforming the rest of the world, do you think that momentum, in your view, and what is your outlook, can continue in the next year when we might have to deal with interest rates going up in other developed markets?
Yes, I think that can continue a little bit into 2022, but I don't think India will be an outperformer. I think we'll be in line performer next calendar year. See, India has got a couple of things that has benefited it. The first thing is that we've seen a lot of retail participation. And although some people say, well, that might create volatility in markets, I actually think it might actually stabilize and offer a better market. It means there's more liquidity in small and mid caps, but also in the past, if something would happen in Turkey or in Argentina, people would sell emerging markets, including India. Now, with local investors, they might not even be completely aware what happens in Turkey or Argentina. It's just not what they're really interested in. And therefore they won't. So it might create stability as well. The other reason why India's performed so well is China has just done not so well. And money has been taken out of China and has moved to India. Now, India had some good reasons for that. Growth was recovering after the COVID situation that you had earlier on in the year. People were underweight at the beginning of the year. They're pretty overweight at the moment. So there were some reasons to believe, hey, India looked pretty good 12 months ago. So we've seen India perform very well on the back of that. But a lot of these reasons are falling away. Yeah, retail investors will continue to stay. That's good, but that's not unique to India. We see this in other markets as well. We think China is starting to recover. It might mean that money gets reallocated out of India into China. Yeah, growth is good, but valuation in India are pretty stretched at the moment as well. So I don't think it's a market you should be selling, but I think we've seen most of it. And from here on, it will be a market performer in line with the rest of the region, I think. And it's really about making money in India on a relative basis, going for the laggards or certain sectors and rotate in between those.
All right, capital rotation has turned out to be a big theme in the last couple of weeks. And is that what you folks are also talking about? You mentioned laggards. Would that be primarily the banking sector?
Yeah, I think that's the banking sector. It's actually certain domestic consumer companies as well that have lagged to a certain extent. So I think that's where you really want to focus on. And a bit of dollar strength and a weaker rupee means that maybe there's a bit of support for some of the export sectors, but it's really in the domestic side where sectors have lagged, and that's where I would look for. Yeah, so private sector banks that still look pretty good, and some of the FMCG companies we like, maybe an auto company as well, but in particular companies with good distribution channels. That's the kind of nature of companies that I will be looking at.
Herald, morning. Just trying to understand, and I think taking from your point where you're saying that the Indian market is going to move in line with the other emerging market peers, I think that is evident, and that is a view, I think, across the board for foreign institutional investors, going by the kind of selling that we've seen over the past couple of months in particular. Do you think that that view will continue going into the new financial year, or do you anticipate that there could be something that could change that view? Do you see a further disjointing between the performance of the US market as well as emerging markets?
Yeah, I actually think emerging markets and Asia in particular will do a little bit better than the US next year. But within that, India will be an inline performer. And I think that's a view, we've actually adopted that view quite recently. So I think that will probably go on for a large part of 2022. And the reason is actually very simple. We think that China, this is the time to go back into China because there's some stimulus taking place, valuations are low, and et cetera, et cetera. There comes with certain risks, but everybody's underweight China. They're really sold out, and they're overweight in India. So foreigners can't really buy anymore. And exactly as you said, over the last weeks, we've seen them selling actually. So I think this process has started, but will take probably a couple of months to fully play out. That doesn't mean that India is bad or something like that. I still think it can go higher. It just means that maybe China can do a little bit better from here than India.
Understood. It's been an absolute pleasure speaking with you, Herald. Thank you so much for taking the time, and look forward to doing so again in the near future.